As a teenager, you are used to people not taking you seriously. However, that's the beauty of investing. Money talks and prejudice walks. Besides, with today's technology, you may not have to deal with other humans at all. So are you ready to start your investing journey? Step 1 in your journey is to gain basic stock knowledge. So what are stocks? Well, think of stocks as a slice of pie, and the pie itself is a company. When you buy a stock, you're buying a piece of that company, becoming part owner, if you will. The value of your slice, your stock, can rise or fall based on how well the company is doing. It's like a roller coaster ride, exciting, right? But don't worry, it's not as scary as it sounds. Now you might ask, where can I learn more about stocks? Great question. There are fantastic resources out there. Andre Geek's YouTube channel, for example, breaks down complex financial concepts in a fun, easy-to-understand way. And then there's Investopedia, a comprehensive online resource that's like an encyclopedia for all things finance. Remember, the key to becoming a savvy investor is to keep learning. The more you understand about stocks, the better your decisions will be. With a solid foundation in stock knowledge, you're ready for Step 2. Step 2 involves identifying appropriate investments. Now, you might be wondering, how do I choose the right stocks? Well, there's no one-size-fits-all answer, but a great starting point is to consider your personal interests. Are you a tech whiz who's always up to date with the latest gadgets? Maybe investing in technology companies could be a good fit for you. Family connections can also provide valuable insights. Do you have relatives who work in certain industries? They might be able to give you the inside scoop on the companies they work for. Business publications, too, are a treasure trove of information. They can help you stay informed about market trends and the performance of different companies. Don't overlook local companies and brands that are popular among your peers. These are businesses that you interact with daily, and you might have a unique perspective on their potential for growth. Lastly, consider index-based exchange-traded funds or ETFs. These are less risky as they spread your investment across a range of companies. So, instead of betting all your money on one horse, you're betting on the entire race. Now that you know how to identify potential investments, let's move on to understanding what these companies do. Before we continue, please consider subscribing to our channel for all the latest personal finance tips and tricks. The more informed you are, the better off you will be. Step 3 is to understand what the companies you're interested in do. Now you might be wondering, how exactly do I do that? Well, one way is by reading a company's annual report. This document gives you the lowdown on a company's business model, its products or services, and its position in the market. It's like a company's report card, showing you how it has performed over the past year. But don't stop there. Keep an eye on news about the company. Has it launched a new product or service? Is it expanding into new markets or facing stiff competition? These news stories can give you a sense of a company's direction and potential for growth. Remember, investing in a company means buying a piece of that business. So, it's important to understand what that business does and how it makes money. If the business model seems too complex or you just can't wrap your head around it, it might not be the best investment for you. Knowing what a company does is crucial before you invest, but that's not all. Let's move on to Step 4. Step 4 is about using financial data to make informed investment decisions. You see, investing isn't just about following trends or your gut feeling, it's a process steeped in research and analysis. One of the key aspects of this process is understanding a company's financial performance. Consider the company's revenue. It's the total income a company generates. A consistent growth in revenue is a good sign, but that's not the only thing to look at. Profit margins are equally important. This tells you how much of the revenue is actually profit. A high profit margin means the company is efficient at turning income into actual profit. Another key financial metric is earnings per share or EPS. It's the portion of a company's profit allocated to each outstanding share of common stock. A high EPS can indicate a more valuable company. But don't worry if this all sounds a bit overwhelming. Resources like Wall Street Survivor are there to help you understand these financial data points. Remember, the aim is to make informed decisions, not just random choices. Armed with financial data, you're now ready to practice your investment strategies. Step 5 is to experiment with dummy portfolios. Now, this is where the fun really begins. Imagine having a go at the stock market without risking a single penny of your hard-earned money. That's exactly what dummy portfolios allow you to do. They give you the chance to practice investing using virtual money in a risk-free environment. It's like a video game, but with stocks and shares instead of zombies or aliens. There are resources out there, like How the Market Works, that provide virtual trading platforms. These platforms mimic real stock markets, complete with real-time data, enabling you to experience what it's like to buy and sell shares, manage a portfolio, and learn from your successes and failures. The beauty of dummy portfolios is that they give you room to make mistakes and learn from them without any real financial consequences. You can test different investment strategies, learn how different factors affect the market, and gain a deeper understanding of the financial world. The bottom line is, practice makes perfect. Once you've tried out different strategies and have a better understanding of how the market works, you'll be in a much better position to make informed decisions when it comes to investing real money. Once you're confident in your investment choices, it's time to choose the right brokerage account. Steps 6 and 7 involve choosing the right brokerage account and avoiding investment scams. As a teen investor, you'll need a trusted adult to open a custodial account for you. This account will be your gateway to the world of investing. But how do you choose the right one? Resources like investor.gov can be a great source of information. They provide details about various brokerage options, helping you make an informed choice. But hold on, there's more to it than just picking a brokerage account. You also need to be cautious of potential investment scams. Yes, they exist, and they're more common than you might think. It's vital to stay informed and vigilant. Always ensure that the investments you're making are legitimate. Don't be lured by promises of quick, high returns. Always remember, if it sounds too good to be true, it probably is. Now that you're equipped with these 7 steps, you're ready to start your investing journey. Remember, investing is a long-term game. Be patient, keep learning, and happy investing.